In this video, we will be talking about capital management and Basel Accord. Um, Even without the regulation of capital, financial institutions management will seek to find the optimal capital structure, which at the highest probability levels will enable the financial institutions to withstand losses without becoming insolvent. Now, one key question is how much capital is appropriate for financial institutions. And this decision could be guided by various finance theories about the determination of optimal capital structure. While considerations relating to these theories play a part, in practice, the decision about the individual financial institution's capital is guided by two factors. First one is the regulated capital adequacy requirement, and second one is the risk-return trade-off available from the use of leverage. Both are important consideration in the determination of capital for any financial institution. For example, management may deem compliance with the regulatory capital sufficient and give lower priority to the measurement, management, and an understanding of the actual risk-return trade-off. In this sense, regulation introduces moral hazard where financial institutions managers have an incentive to rely on regulatory capital and not on an internal assessment of actual risk and capital required. For example, in 2008, in 2008, during the global financial crisis, the Royal Bank of Scotland, despite complying with capital regulations, failed due to excessive risk-taking, leading to losses which far exceeded its capital. In the case of RBS, regulatory capital was not sufficient. So in the subsequent slides, we will be talking about these two measures of capital adequacy, leverage ratio and risk-based capital ratio. First of all is leverage ratio. Leverage ratio is simply the ratio of a depository institution's book value of primary or core capital to the book value of its assets. The lower the ratio, the more highly levered the financial institution is. Primary or core capital is measured as the book value of a financial institution's common equity. The leverage ratio has a number of problems as a primary measure of capital adequacy. For example, first problem is with the market value. Even if a depository institution closes when its leverage ratio falls below the regulated premium, there is no assurance that depositors, regulators, and taxpayers are adequately protected against losses. The second one is that by using total assets as denominator, the leverage ratio fails to take into account even partially the different credit, interest rate, and other risks in the depository institution's asset portfolio. The third one is not all depository institutions have the same business risk, and so a one-size-fits-all approach along with the simplicity of the ratio may not adequately capture the variation in the risk exposures. The leverage ratio also does not take into account off-balance sheet activities, and capital regulation based on the ratio alone ignores any capital requirements needed to meet the potential insolvency involved with contingent assets and liabilities. The definition of capital in this leverage ratio also fails to include non-equity capital such as long-term debt. And finally, traditionally, the subsidiaries of a bank fell outside of the leverage ratio's rule, giving an incentive to banks to establish subsidiary operations to circumvent the capital regulation. Due to the problems associated with this leverage ratio as a measure of capital adequacy, a new measure of capital adequacy has been proposed by the Basel Committee, which is the risk-based capital ratios. Now, just a small background that a Basel Accord was first developed by the Basel Committee of Banking Supervision in 1988. This Basel Committee on Banking Supervision is a committee uh, comprising representatives from central banks and regulatory authorities. So first of all, this Basel Committee came up with a set of regulatory requirements for the bank, which is known as Basel I. So Basel I was the start of a new regime in the regulation of depository institutions' capital, incorporating the riskiness of depository institutions' asset portfolios. Improvement in the measurement of risk-adjusted assets led to a second accord, which is known as Basel II, introduced in Australia in 2008. So once again, Basel II is again a set of regulatory requirements, but that was an improved version of Basel I. The GFC was a further game changer with respect to both the supervision and regulation of depository institutions. The fact that Basel II did not stop the GFC was a major concern to government, leading to further revision of the measurement of risk-adjusted assets in capital regulation in 2012, the so-called Basel 2.5. The Basel III Accord, which is a more improved version of the regulations introduced in Australia on 1st January 2013, established significant changes to the measurement of capital, as during the GFC, many banks were found to have insufficient capital to manage through the extreme economic downturn. Now, as I told you that the Basel II essentially was an improved version of the Basel I, particularly in terms of the additional capital against operational risk exposures. So Basel II has three mutually reinforcing pillars. For example, the first one is capital adequacy requirement. The definition of capital and the methods of measuring risk-weighted assets, including specific charges for operational and interest rate risk in banking book for some depository institution, was specified in Pillar 1. Pillar 2 is mostly about supervisory review process. So this includes the depository institution's own assessment of their capital adequacy, as well as enhanced supervision of capital management by APRA. And Pillar 3 of the Basel II is mostly involves disclosures, materially increased disclosure requirement by the depository institutions through Basel II, including disclosures of regulatory capital structure, capital adequacy, and credit risk information. While the measurement of capital did not change markedly in Basel II, the measurement of risk was significantly enhanced to include operational risk, so market risk in the banking book, and the risk associated with securitization. Now, as I just indicated a few moments back, that since Basel II couldn't stop GFC from happening, so a more improved version of the financial institution regulation was introduced through Basel III. So the main motivation of Basel III was the GFC. While there were industry and regulatory concerns, the driving force for change was the Group of 10. I think you know that Group of 10 is the Forum for International Economic and Financial Cooperation, which brings together advanced and emerging economies made up of 19 countries, plus the European Union, representing 90% of the global GDP, 80% of the global trade, and 2/3 of the world's population. Basel III is broader in perspective than just a revision of capital adequacy, risk measurement, and their supervision. It also introduced the first global liquidity regulations in response to critical global liquidity shortage that resulted from the failure of financial institutions during GFC. Now, as I already said, that this Basel Accord has three pillars. The pillar 1 is mostly about improved coverage of risk arising from complex structured products and securitization, as well as higher capital of for market risk. So this pillar one actually indicates higher capital requirements for so it actually requires more common equity. It requires some countercyclical buffers. We will be discussing this point shortly. It also requires that financial institutions become less reliant on external ratings for securitized exposure, and it also requires higher capital for lending to banks in relation to trading and derivatives, and the measurement of a stressed VaR we learned in one of our previous lectures. Pillar 2 is the supplementary guidance to address flaws in the risk management practices revealed by the GFC, covering institution-wide governance and risk management processes, management of risk concentrations, and the capture of risk from off-balance sheet activities and securitization activities. Pillar 3 mostly involved about the strengthening the disclosure requirement for activities identified in Pillar 3. The Pillar 2. So these are essentially the capital requirements under the Basel Accord. During the GFC, the regulators learned that a number of large banks that had excess regulated capital failed and nearly failed. With this in mind, Basel III has redefined capital and has placed a greater focus on common equity, the highest quality component of capital. Total regulatory capital consists of two elements: the Tier 1 capital. This is what I'm talking about, the Tier 1 capital, and the Tier 2 capital. So Tier 1 capital, which is known as going concern capital, and Tier 2 capital, which is known as gone concern capital. Tier 1 capital again comprise of two components. One is the common equity Tier 1 capital, and another is the Tier 1 capital. So common equity Tier 1 capital, common equity is the highest quality component of capital. So it is subordinated to all other types of funding, absorbs losses, has full flexibility of dividend payments, and has no maturity dates. So these are the main characteristics. The additional Tier 1 capital, on the other hand, the concept here is the non-common equity elements included in Tier 1 capital must be able to absorb losses while the depository institutions remain a going concern. APRA requires that additional Tier 1 items are loss absorbent on a going concern basis, subordinated, have full discretionary non-cumulative dividends or coupons, and have neither a maturity date nor an incentive to redeem. So these are the components I'm talking about. Tier 2 capital is used to provide loss absorption on a gone concern basis and must be subordinated to depositors and general creditors and an original maturity of at least 5 years. For liabilities with a remaining maturity of less than 5 years, recognition in regulatory capital will be amortized on a straight line basis over the final 5 years to maturity. Now, this is the minimum limit summary, which says that common equity Tier 1, you can see common equity Tier 1 must be 4.5% of the risk-weighted assets of all time. So common equity Tier 1 divided by total risk-adjusted assets has to be at least 4.5% according to the regulatory requirement in Australia. Total Tier 1 capital must be at least 6%. So it means that total Tier 1 capital divided by total risk-adjusted assets has to be 6%. And total capital must be at least 8% of the risk-weighted assets. So total regulatory capital divided by total risk-adjusted asset must be greater or equal to 8%. So in this video, we have learned about the capital measurement, and we have learned about the capital requirements according to the Basel Accord. So in the next video, we will be talking about how we can measure the denominator, that means the risk adjusted assets. Thank you very much.